Many times in accounting, we will encounter uh, areas where we were going to have to approach a problem in many different fashions. We're going to be looking at a situation where we have a change in accounting estimate. And unlike other changes in accounting estimate, this one's handled a little different. So sometimes we have to alter our plan of attack. In the first video for this series, we had a situation where a company awarded 12 million options that had a fair value of $5 per option. We anticipated no forfeitures. The options were granted on January 1st, 2011, and they could be exercised no sooner than December 31st, 2013. The time period between the grant date and the exercise date is known as the vesting period. And it's over this period that we will recognize the compensation expense. In 2011, we anticipated that we would recognize compensation expense of $20 million per year over the next 3 years, and we anticipated no forfeiture. That is, everybody who was awarded the options was going to exercise those options. Now in 2012, we have developed new information, and we believe that 5% of these options will not be exercised. And we are going to have to account for the effect of this new information on the 2012 earnings and the 2013. That is, we are going to have to adjust our compensation expense. So instead of being $60 million, a forfeiture of 5% will cause the overall fair value of the reward to be the original amount times 1 minus the forfeiture rate, or 95%, or 57,000. Now, this 57,000 should have been expensed over a 3-year period. So 1/3 of 57,000 is $19,000 per year. In 2012, we have this new information, and GAAP says that unlike most changes in accounting estimates, we are not going to allocate the remaining expense, the $37 million over the next 2 years. Instead, in 2012, we're going to use the new information to bring retained earnings where it should be if we had used this information in 2011. And this is what I mean. In 2012, we're going to recognize the $19 million based on the new information. We're going to subtract from that the amount that was recognized in 2011 minus the amount that should have been. That is, we're going to subtract $1 million, the $20 million that was actually expensed, minus the amount that should have been expensed based on the new information of $19 million. So for 2012, we are going to recognize compensation expense for $18 million. So now over the 2-year period of 2011 and 2012, we have recognized $38 million in this compensation expense, which is equal to the annual allocation amount times 2. Therefore, in 2013, we will recognize $19 million, meaning over the 3-year period, we will be recognizing $57 million. Again, this is unlike the way we handle changes such as changes in the useful life of a depreciable asset, where we pick up the new information and use that from that point going forward. For compensation expenses, there's a special rule that tells us to adjust retained earnings to the amount that it should be if we had known this information all along.